This is Mark Sobel, U.S. Chair, OMFIF. Today, I'm delighted to be joined by Anna Wong to discuss yesterday's FOMC and the monetary policy outlook for America. Anna is Chief U.S. Economist for Bloomberg Economics. Before joining Bloomberg, Anna worked at Federal Reserve Board, White House Council of Economic Advisors, and the U.S. Treasury, where I had the fortune to meet her and gain a strong appreciation for her great work and brilliance. So welcome.
Hi, Mark. I'm very honored to be here because not only did you met me at Treasury, I actually work for you. So it was actually my honor to be here to be talking to my former boss.
Okay, we'll see if you're saying that after we're through with this interview. So let's get your overall take on yesterday's FOMC. So the meeting took place against a background of a sharp drop in longer-term yields and increased market expectations of Fed rate cuts next year. We knew the Fed funds rate would remain unchanged. I had actually expected a relatively subdued affair, including some pushback against the market. But the meeting seemed far more consequential in the end. So, what was your take? What about the dot plot and press conference caught your eye?
Yeah, we were actually one of the very few in the market who expected Powell to talk about rate cuts. In fact, to acknowledge that they had been talking about the rate cuts. But I was also surprised by how openly he talked about rate cuts. We thought there would be slightly more pushback as you, but at least that we did think that there will be some for him to talk about rate cuts. So where it surprised us is that at the press conference, he focused a lot more on. So two quotes particularly was notable to me. Number one, he said, "We're very much focused on not over tightening." Basically, a month ago, he was saying they were focused on not making the mistake of Arthur Burns. They're focused on keeping rates higher for longer because because inflation is too elevated. And a month ago, he also talked about long and variable lags of monetary policy, that they think that some more restraint on the economy is coming. But yesterday, he spent another 50% of his press conference talking about how unemployment rate is not going to rise rise much, even though growth is slowing, and everything else is slowing. Inflation is slowing, but just it sounded like he is very confident that soft landing is at hand. And the fact that he delivered a very dovish pivot will make that come true. So the reason why we were not surprised that he will talk about rate cuts, we did think that within FOMC, the deliberations are much more dovish than they seemed, is that we thought that the data really deteriorated in October. And from the Fed's perspective, Fed officials, what they do is they talk to the district contacts all the time, for a businessman and economist all the time, and to gather a real-time view of the momentum of the economy, right? And all that is captured in the Beige Book. And the October Beige Book was very significantly downbeat. And if we were to use any fancy NLP techniques to gauge the sentiment from the Beige Book, it will be as bad as any downturn in the beginning of downturn. And after that Beige Book came out, you can hear from Fed officials' tone that they suddenly were very confident that the disinflation process will persist. They're more confident than before, and it sounded like they are more concerned about the growth outlook. And this is where Chris Waller's pretty meaningful speech came out. Chris Waller said a while ago that something's got to give in the economy in order for disinflation to continue. And then he followed up with a sequel of a speech called "Something May Be Giving," and that speech came out after the Fed's Beige Book. And so I think this is the reason why the Fed was ready to be dovish because they are interpreting the loosening of financial conditions as a rather as a as the economists say, as an endogenous response to weakening growth rather than some exogenous event that will stimulate growth, right? It matters for the reason for why financial conditions is loosening. And yesterday, Powell basically poured fuel on this fire of financial loosening, which I think rather than you know, you know, pour fuel on inflation, as some people think. If indeed the loosening of financial conditions in the past week was really a response to worsening growth outlook, then it's actually good uh, in supporting growth because we all know that monetary policy have long and variable legs, right? But by delivering that really dovish pivot, it instantaneously uh, uh, exerted some easing, monetary easing, and that actually would that easing the that effect of the easing would actually arrive early in 2024, which is when we think the downturn is will be gathering force. So I think that this actually significantly improve his chance of soft landing. I'm not sure he was on track on to a soft landing before, but after the dovish pivot yesterday, I thought it will increase his chances.
Okay. So you use the term pivot. In basketball, the pivot's not that big of a move. This seemed like a bigger than that. Uh, you know, I think the other thing that caught my eye was that he typically paid a lot of attention to financial conditions, but he didn't seem worried about financial conditions easing too much yesterday. And that was ratified when, in my mind, when he said all three components of the inflation basket that they look at were declining. So what is going on with inflation? You know, there's so many inflation measures. There's too many to know what to look at, but it's coming down nicely. Oil prices falling, shelter prices falling, or projected to come down. But there are those who still argue that wages are going 4 to 5%, and that's more consistent with 3% inflation, not two. And services prices stickiness. And then they argue, well, the last mile to 2% will be hard. So, uh, what do you what's your take on the inflation outlook and the last mile debate?
Yeah, I also neglect to mention in another reason why Powell sounded so sure about the rate cuts yesterday. It was the inflation news yesterday morning. So yesterday morning, the PPI for November came in, and typically once you have PPI and CPI data for the month, Fed economists would immediately map all those PPI, CPI number, hundreds of them, into a PCE number. So basically, yesterday's morning, the FOMC official already have in their hand the November figure for core PCE. And despite the upside CPI surprise earlier this week, where core CPI grew 0.3%, mapped all the components into core PCE, it was actually showing a core PCE for November of only 0.04%, almost 0%. So this is what, and that immediately changed the near-term outlook for core PCE inflation. That means that the in the last quarter of this year, core PCE would be averaging 3.2%. And it's clear from the updated summary of economic projections yesterday that Fed officials took on board this new data point from yesterday morning. That's why they revised down core PCE to 3.2%. Now, on the various measures of inflation that matters to the Fed, right? So core PCE is important in that it tells you the momentum of underlying inflation. So, but within the core PCE, there's also, I would say, um, two other ways to see it that matters, really matters. You could have infinite of that, but really it's two that matters. One is to look at core PCE on a 6-month annualized basis, because if you look at it over 12-month year-over-year basis, then there's this base effect thing, and like it depends on, like, last year oil price was high, so you can argue about whether the year-over-year decrease is due to high oil prices last year. But if you look at it on a 6-month annualized basis, it kind of sort of bypass that base effect, and it gives you a decent period to look. And I think that's actually the implicit target of the Fed, that they're looking at 6-month annualized. And if 6-month annualized number fall to a certain threshold, that is when they are ready to cut. Because Powell also said yesterday that they will not wait until the 12-month change fall to 2% to cut, because that's too late. And implicit in that is that they're looking at the 6-month measure. So based on yesterday's PPI number, the 6-month core CPI measures is actually on track to fall to 2.2% by March of 2024. And that is why we thought March 2024 is the timing for the rate cut. However, regarding the debate of the last mile of inflation, the last mile I think of as lowering inflation from 3 to 2%. And so even though in March 2024, core PCE on a 6-month annualized basis would be already at 2.2%, I did find that there's still some lingering base effect. There is some favorable base effect that was helping uh, um, the March figure, that if we continue at a steady pace where core PCE is growing at 0.23% per month, 6-month annualized core PCE would actually rise back to and stabilize at 2.7% thereafter the rest of the year. So likely what we're going to see in 2024 is first a dip in the first half, and then a slow increase back to like close to 3%, not at 3%, but still very quite close to 3%. And I think that's the last mile. I think 2.7% core inflation is still higher than the Fed's target, because Powell is very clear. It's 2%. It's not 2.7. So I think that extra 70 bips is the hard mile. And I think looking at it from an economic theory angle, there there are good reasons why there's this hard mile. So think of it from the Phillips curve angle. So the Phillips curve is this empirical regularity that relates unemployment gap to inflation. It's basically, it says that as long as the labor market is tight, then inflation will be growing. And the high inflation in the past 2 years, I mean, part of it is because this Phillips curve is nonlinear. That once you run the economy really hot, the labor market is really hot, then wages tends to grow significantly faster, right? So that's why when you're trying to lower wage growth from 6% to 3%, you're in that steep nonlinear path where you only need almost no labor market loosening, little bit of labor market easing. But once you get down that long nonlinear path and then get to where wage growth is more like 3%, then you're in that very flat portion where you actually need some significant labor market easing, right? And this nonlinearity is actually in the data. It's like as clear as daylight for people to see. And so I think to a lot of layman's, 2.7% core PC inflation sounds low enough, right? And but from the Fed's perspective, 2.7 is not 2%, and the Fed's mandate is 2%. So I think the debate in the next 2 years would be, why should the Fed cause a lot of hardship on the economy in order to lower inflation from 3%? back to 2%. That would be the debate 2 years later.
Okay. Well, we'll come on to that. So let me ask you about the growth outlook, and because it seems as if everybody's buying into the soft landing story. Um, but you just pointed out the October beige report wasn't all that sanguine. I think there still are those who believe a recession is a distinct possibility. I'm not going to put words in your mouth, but I think you're in that camp.
Yes.
So it seems as if the Fed is confident about a soft landing, and inflation falling. You're confident about inflation falling, though you have a little bit of a last mile, plus you have a recession potentially in your outlook. So is that fair?
That's fair. I'm in the recession camp. And I can tell you why. I mean, one of the reason why I thought, in fact, I even think that there's a likelihood that the recession already started in October, that a year from now, or even a year and a half from now, if MBR were to date a recession start, or the definition of recession is the peak of a business cycle, and the month after the peak of a business cycle is the recession. And I thought October is a good candidate just because GDP growth was gangbuster in third quarter, and thereafter you start to see this suddenly non-linear narrative of how things are falling off the cliff, right? So in the beige book, what alarmed me so was that 2/3 of the Federal Reserve districts reported flat to declining activity growth, and also very widespread narratives in the beige book. So the beige book is a collection of anecdotes, right? So anecdotes do not get revised, not like economic data. So it's firmly there, and so very pervasive narrative there is that there are more job applicants for each of the job opening, and that firms are increasingly relying on attrition to manage, not attrition, sorry, layoffs to manage headcount, because people are not quitting as fast. So last 2 years, the big story is the Great Resignation. People are quitting. Um, and so, from a firm's perspective, HR manage the headcount by each year assume a certain people would voluntarily leave, and for them, that's how they manage the headcount, right? So, if people stop leaving, then firms start having this bloated payroll cost, and if growth slows, not goes negative, just all you need is growth revenues of the firm to slow down as people are not quitting, then that's how layoffs begin. You don't need, so that's the beginning of a recession. A beginning of a recession is not like a Lehman moment. I think in a lot of people today have not experienced a recession before, and the most modern one is the 2008 recession. So you think that it's this dramatic thing, right? But it's not. Recession usually begin with very slow drip in the labor market. And so my team actually went back to all the FOMC transcripts to, and also beige book and minutes to look at how the beginning of recession sound like from an anecdotal perspective. And usually, almost in all of the beginning of the recessions, FOMC officials would characterize the labor market as tight and fairly tight. And not only that, that would be how business contacts in the beige book describe the labor market as well. And why is that? It's because, so a lot of most recessions are caused by two factors: the Fed murders them, or an exogenous adverse oil supply shock. So the long and variable lags of monetary policy is actually the longest for labor market. Um, in the academic literature, the lags for labor market from rate hikes is about 18 to 24 months. And so when you think about that lag, this is the time when that lag is supposed to be hit the hardest. And this is exactly what we're seeing in anecdotes where people the job creation is slowing, but not negative yet. But it means that people are finding it harder to find a job. People stay unemployed longer, and over time, usually about 2 to 3 quarters into a recession is when firms start to have to undergo mass layoffs. So this is why, a tight labor market is not a definitive data point of a soft landing at all. This is always how it begins.
Okay, so a recession potentially on the way. It seems to be people say soft landing, recession. It's going to be stagnant for
Oh,
sure.
but Mark, actually, I did say that I did say in our 2024 outlook that if the Fed managed to cut faster, larger, and earlier, they can achieve a soft landing. And Powell's
You said
performance
that
yesterday,
earlier. Exactly.
yes, exactly.
Anyway, putting everything we've been discussing together, so markets are pricing in sharp Fed funds rates cuts next year, over 100 basis points starting in March, I think. The Fed before yesterday seemed in sync with higher for longer, and many economists still don't expect the Fed to budge till the middle or the third quarter, um, even if they did up the cuts in the dot plot yesterday. So, what's your take?
Our take is for a Fed rate cut to begin in March 2024 and followed with another 100 bips in 2024. So for a total of 125 bips cut in 2024. And Mark, I just read that Goldman did change their call now on the Fed path today. And they are also seeing a cut in March 2024. I think after yesterday's Fed meeting, everybody in Wall Street would be moving to a March 2024 rate cut.
Okay, well, so let me ask a question. This different question that's on my mind. So a few months ago, we saw the 10-year yield surge to 5%. Um, and there was lots of concern about that. And now it's plunged to under 4%. Um, so the Treasury uh, is running, well, the US is running huge deficits, and the Treasury is putting out a large amount of paper on the markets. It's going to continue to do so. The Fed isn't buying treasuries. They're in QT mode. Um, you know, when we were both at Treasury, the Chinese were buying treasuries like crazy because of their reserve accumulation. Reserve accumulation isn't really happening these days. If anything, central banks are selling to cushion the dollar's rise. Banks are constrained. And so that doesn't leave too many buyers. And yet the rates just plunged 125 basis points. So what's going on? Should we not be worried about the U.S. deficit and the market's ability to absorb supply?
Yeah, the markets, Wall Street is a very funny animal, isn't it? This is how I understood the driver of each of these up and down phase of the 10-year Treasury yields. So I think it all started after Fitch downgraded the U.S. Sovereign rating, and at that time, most economists shook it off, and say also traders shook it off. But I think what the Fitch downgrade showed and drew a lot of attention to ultimately is the fiscal unsustainability. So if you look at the budget deficits, you would see that it's been deteriorating. It was on track at that point to reach 6% of GDP at the end of this year, and you realize that this is supposed to be a boom year, and usually the deficit improves in an economic boom, not deteriorate to 6%. And so I think that moment, like in terms of sometimes something happened and it jump starts a long chain of events. That is the moment where people start looking at these stuff. People used to like close their eyes to it. And so suddenly, after that Fitch downgrade, people are obsessively looking at this monthly Treasury statements, looking at like when the like what the budget deficit is on track to be like at the end of the year. And so somehow along the way, economic data was also stronger. In the third quarter, there was a GDP boom. And so in Wall Street, there was a very heated debate on um, uh, whether the 10-year yield surge in October was due to stronger data or is it due to concerns about the sustainability of the deficit and also QT. And where the Fed comes in, as well as where we came in, is that we thought the October surge was due to a rise in term premium because there are a whole bunch of economic models that isolate the term premium component. And usually an increase in term premium is driven by two things. Either concerns about sustainability of fiscal balances or QT. And both of those two things were present. And so we thought, and also the Powell was pretty clear in the November FOMC meeting that they also interpret it that way. But the markets did. The market thought it was driven by positive growth price. So it actually does matter what is the driver of this 10-year yield. Because if you think it is a stronger economic growth that drives 10 years, because people are thinking that the Fed will have to hold higher for longer and all that, then you wouldn't be as worried from a policy maker's perspective, right? Because this is endogenous to stronger growth. And you need higher yields to restrain the economy to stop inflation from flaring up. But if you think it's more like term premium, people's attitude, risk attitude toward holding longer dated bonds, then you would be worried. And that's exactly what the Fed's attitude was. They were worried that this would actually drive economic growth down from a exogenous perspective. And this is why the October base book was so bad. And this is actually led to this chain of event why the Fed has this dovish pivot yesterday. And so why is the then so economic Treasury yields then fell in November, and why is that? So we got the third sometime I think in at the end of October. And that was when Bill Gross and Bill Ackman came out and say that there will be an economic downturn in the fourth quarter of this year, right after this GDP boom. That's exactly what we said too. and that was the turning point. If I have to pin down the turning point, is that Bill Gross, Bill Ackman moment. And that started the whole rally in bond market. And that rally was driven by perception that growth is slowing. And as you know, typically when there's global growth slowdown, when China's in trouble, Europe is in trouble, 10-year yields went down too. That was what happened in 2015, 2016, 2012, right? So this fall, dramatic bond rally was driven by actually growth concerns and weakening growth. So this is why the Fed is not worried about this one. But whereas they were worried about the increase previously, it depends on whether growth is the key driver of it. Yeah.
Okay. Well, thank you for that. So much for supply and demand. Um, I could ask you a ton of other questions, but you probably have a day job to get on with, and I will save questions for you for later, for another day if you'll ever rejoin us. So I want to thank you for joining us today to discuss the yesterday's FOMC and your monetary policy outlook. Very helpful.
I would love to. Thanks, Mark.